It's my pleasure today to welcome Sander to Hartog and Lim, there you go, today for this PACE session on financial and management accounting, a symbiotic relationship. It's an interesting topic. Sometimes we think they're not mutually incompatible. So it should be a very interesting topic today. Having said that, Sander, please take it away.
Perfect. Thank you very much, Rafe. We'll make some time at the end of the presentations to do some questions. So no worry about that. You'll get your time to ask some questions. But in the meantime, it would be a little bit helpful if we would all put on mute so we don't have like background noises and everything going on. Having said that, before we start, I'd like to quickly introduce myself, but also Lim as our guest. And I'll start, of course, with the guest, but in this case, it's not so much as a guest for me as you would expect, maybe, because Lim used to be one of the founders of CostPerform, but is now a subject matter expert at the USPTO. But Lim, please, if you could introduce yourself a little bit, that would be helpful.
Yeah, thank you, Sander, for the introductions. Yeah, I've been working with CostPerform since 1993. Founded CostPerform, one of the founders, and my role changed from being in its core consultant to sales, and now back to consulting. And one of the projects I'm involved in is I do a lot of work in the U.S. federal government, and one of the projects I'm on the team at is the USPTO, and I've been working with them for probably close to a decade now. Yeah, in a nutshell.
Perfect. And maybe good, like location-wise, and that's also an interesting part of our business. I'm in our head office close to Amsterdam. Lim is in Baltimore, where we have one of our other offices. But so one is in the US.
Actually,
yeah,
but actually live in Amsterdam as well. So I travel up and down all the time.
Yeah, but that's a little bit the work we used to. What I'll do, I'm going to try to share my screen, and I'll ask you to confirm, Lim, or whether or not you can see the presentation.
Yep.
Perfect. Then I'll take it from there. As said by Rafe already, we're going to talk a little bit about financial and management accounting and how to use or not use them, and what works in practice, and especially how to use them in cost modeling as well. So we'll use the USPTO as a use case for that. I'm going to start off with a little bit about CostPerform, that you guys have a little bit of an idea who we are, and that also is a big part of my introduction because I am the CEO of CostPerform. We are a 25 people shop nowadays, and we provide cost management services, especially on the tooling side. So we mainly provide a piece of software called CostPerform. Around the world, we are currently active in 46 countries with around 200 active clients. I'll tell you a little bit more on CostPerform. I tried to keep that short because we'd like to really give you something to learn and not so much of a commercial presentation. So what we'll try to focus on is how we see the differences between financial accounting and management accounting. And me and Rafe have been working on that a little bit longer already. Then I'll tell you a little bit, okay, now that we know the differences, how do you then in practice deal with issues to get to cost price modeling using both the principles? And then we'll get into a use case, which Lim will be presenting about the USPTO. And Lim has a good story also about the maturity, since he's been already there for a decade. He can see a little bit of maturity levels rising, and I haven't seen quickly. I don't see Gary is being present here, but that maturity level that we talk about has been actually developed in an article which was authored by Gary Kokins. With no further ado, let's get started and give you a little bit of background of CostPerform. The way we look at the world nowadays, but also with regards to the future, we truly believe that every type of organization, and I've seen a little bit of the list of participants that we have at the conference today. I've seen that at this webinar, I've seen there's a lot of like different types of organizations, whether it's a government organization, whether it's a bank, whether it's a factory, there's like all different kinds. And we truly believe that it doesn't really matter what kind of organization you are, but you will need sooner rather than later some kind of cost transparency. And that's easily driven by internal elements, but it could also be driven by external elements. Like in the case of the federal government, there's usually somebody who is regulating that, wanting to know a lot of that that transparency. But also, for example, in our situations where we have a telco, there's always a regulator regulating that telco market, being very specific on what kind of costs should or should not be included in the price. So there is going to be a pressure for cost transparency. Internally, you would like to know your margins, you like to improve profitability. So there's other types of pressures there as well. And we believe that the abundance of data is only growing. So the possibilities to actually combine that pressure and the availability of data to make really detailed cost management models, that's what our mission is. We want to make sure that we will be there supporting you to make these kinds of models and get a grip on understanding the link between cost and performance within your organization, and therefore improve it. It's as simple as that. That's why we are here. And yeah, we've been here, like Lim was saying, already for a long, long time. We are actually now in a little bit in growth phase. We've been growing, 40 to 45% over the last 16 to 18 months. So we're doing nicely.
माइक पर जाके जो कैमरा चली जा रहा है
Please, yeah, thank you, Moise, for putting it on mute here. And we do that for a lot of clients, as I already told, and these differ a little bit between a lot of like banking clients, as well as governmental clients, as well as telco clients. I guess most of you will know some of them. British Telecom is, of course, a famous name, just like Vodafone, but maybe not as familiar for everybody. But this is like the National Bank of Belgium. So it's really like the Federal Reserve, that, but then from the Belgian country. The Navy is very familiar as well. A big bank in Belgium, KBC, just as the Dutch big bank ING is there. So all over the place, the whole department of Dubai, the governmental financial institutions there are also part of our portfolio. Pretty over the place, because the principles that we're going to talk about today is pretty universal. On our beliefs in costing, because we don't make these software adjustments that we're currently making. We have a whole department that is doing the development, and we'd like to give them some guidelines on which areas they should develop towards. And one of that developments, and that's also pretty much in line with Lim will speak about later, is that we really truly believe that organizations have more difficult questions tomorrow than they have today. So what I always say, if you start out with CostPerform, don't worry about the fact that you're probably only using 20% of the functionalities that you have now, because in due time, you will probably get to 40 or to 50%, maybe even to 60%. But honestly, there's not a single client that is using more than 60% of the functionalities. And that is not because the other 40% is obsolete, but that's because of the fact that different clients have different levels of maturity, but also different wishes to watch their cost modeling. And it has been always our mission to be as broad as we can in the functionalities of cost management. And therefore, we really like to ensure that if clients start with us, they stay with us, even though they really grow in maturity. Now, and USPTO is a very good example of that. Where they have actually grown in maturity, but have never been able to outgrow their tool, luckily. But that's on purpose. Then second thing that we see, and I've been with the company now for 6 years or something, when I started out, I really saw that a lot of our clients were only doing cost calculations, cost modeling once a year to do a sort of like assessment. What is our cost pricing and how should we use that in our commercial department as well? So that would be a 4-week project where, or maybe even a 6-week project where you would collect data, clean up all the data, build out your cost model, and at the end of the 6 weeks, finally get your cost prices. But imagine if you are as say USPTO and you do it every quarter, then a 6-week project every quarter is going to be already taking up a lot of your time. But now we see most of our clients even going to a monthly situation. Well, taking 6 weeks out of a month is quite a challenge to get that done. That's not going to happen. So what we see, and that's what we tell our people in development as well, that automation and repeatability of that kind of procedures, and therefore also our software should support that, is a key element to improving your processes and procedures. Then last but not least, what we've seen also shift more and more, and this is the one that I'm most happy about, is that where it used to be the case that these kind of info around cost management and cost prices and operational excellence would be only stuck within the finance department, since there you had the business controllers, there you would have the cost controllers sitting. They would actually be there with the information, trying to share that in reports to others. Nowadays, we see more and more that they actually open up a whole dashboarding and open up the tooling as much as possible towards the whole organization. So what we see is a large demand of dashboarding to be that able to get it in front of operational people, to get it in front of commercial people, and not only to the finance. So these are like the 3 main areas that we see evolving and that our people are developing upon. And yeah, I hope that you guys recognize it. A little bit on, what is then happening in our case of CostPerform. We truly believe that you could actually break any cost management project down into 3 phases. You have to collect data, you have to model your data, and it has to be back and coming back to actionable information. And if you really break it down, we always say our tool can be seen in like 9 free key areas, 3 areas in the data collection part, 3 areas in the data modeling part, and then getting the reports out. The heart of the matter, however, is still like the modeling. That's where we're going to spend most of our time nowadays. That doesn't really it doesn't really mean that not a lot of time is spent on getting the data there as well. But for today, the topic is going to be mostly about the modeling that can be done and will be done within our software. Where do our clients use it for mostly? Well, we've talked a little bit about product and customer profitability. That is mostly the use case for USPTO as well. However, they have a very strong IT model in there as well. Lim will talk about that. So there is a IT chargeback to the different departments as well as since it's government by the government, there is a large regulatory reporting aspect to it as well. So there's always multiple use cases that are used by different customers, and they are actually looking forward to playing around with budgeting and forecasting and scenario analysis. That's why the USPTO case is so appropriate, because it touches upon most of these areas. Getting to the heart of the matter, managerial costing. Some of you will probably, at least Rafe will recognize the ebook, Managerial Costing, Why is it important and How to Do It. It was Rafe who was the author of it, and we've been a proud sponsor of it. And if you look at the book, you see that what we've talked about there is that managerial costing is done to provide accurate and relevant cost information for decision support. Remember, that is something different than financial accounting. Financial accounting is something to comply with regulatory standard, to comply with all kind of financial regulation. It's not so much for internal decision support. So that's already a big difference. And what it comes with is the fact that you don't have any mandated rules or standards, but you have principles that you can adhere to and concept that you can adhere to. You can say, oh, I want to play around and say overcapacity. I want to either allocate it out or I want to stay with it. Well, that is a principle that you can decide for yourself. The big difference also between managerial and financial accounting is that usually managerial accounting is very much grounded in causality. So cause and effect. If something happens, say, for example, at the volume of a product or a service that triggers something in your activity. So I have to provide some extra activities, which actually draws upon the fact that you need resources. And when you need resources, that usually draws upon the fact that you have cost. So there's a lot of like causal relationship between your cost and your services. That doesn't have to be the case in financial accounting. And that's where it differs from financial accounting. I've made a little bit of a table so you can see a little bit some, I'm not going to go through it. I think we can later on share the slides because all of the information is going to be public anyway. And if you look at a few items, say, for example, depreciation, from a financial accounting perspective, where you want to account for your whole year, say that we're looking at the cost of 2023, we have the complete GL in there, and of course, depreciation is in there. So you'll have to use based on the historical cost, you have to look at it. But in a managerial costing situation, you might want to look differently at depreciation. I'll give you an example on a manufacturing site. Say that you have like 2 production line. One is the new one, was just installed last year, and one is the one that was already there when Lim started with CostPerform, so back in 1993. And by now, that production line is probably completely depreciated. The other one was just installed, so has a very high depreciation cost still in there. And if you would actually treat them based on the real historical depreciation cost, you would always say, oh, please produce my product at that old line because that doesn't have any depreciation cost anymore. It's going to be a cheap product. But that would be a very illogical way to look at it, because you, of course, you want to go through the new production line because that's a better and more efficient line of it. So in really cost modeling, you might want to look at it differently and say, oh, I want to look at it from a replacement value lens instead of an actual lens. Other example to talk about is like, yeah, in the principle within financial accounting, you really have to look at your historical cost. If you have 100 million of cost in 2023, you want to make sure that 100 million of cost is accounted for. If there is like revenue exactly from that period, you want to make sure that it is accounted for. Whereas in managerial costing, you can work with standards. You can say the rate for a person is such and such, the rate for a machine is such and such. And with the volumes that I have, I could actually calculate the cost in there. So that are a few of the of these differences. Same as for overhead costing, where they are identified within the organization, but in managerial costing, you want to look at it from a causality perspective. This is all very nice theoretically, and this is what I advocate when I do lectures and books. But to be honest, in reality, it is a little bit different. And in reality, I always use this scheme, and I'll try to quickly cover it. Because in reality, what you see, you have your input data, and any CFO which would be driving a cost allocation and cost modeling, always, especially when it's regulatory based, it doesn't have any means to say, no, I don't want to have a managerial costing, because probably the regulator tells them, I want you to make a cost model based upon your 2023 data. And I want you to account for every penny or every dollar that is in the 2023 data. So you have to start with your input. And then when making your cost price model, you're going to try to make as best as you can comply with the laws and regulations, which is an example that I just gave. You're going to apply to managerial principles that you've set for yourself. And sometimes you have to make assumptions or estimates on how to deal with that cost if you don't have all the standards. And that gives you a cost price for 2023. But that cost price of 2023 might hold some elements that are, maybe very specific for 2023. Say, for example, that you've had to do a sort of like a layoff some of the laborers, and you had a lot of layoff costs which were incidental. Or say that you had an incident in one of your buildings, a big fire that you had to cope with and everything. Is it then very fair to put that in your cost price? Shouldn't you put sort of like a standardizing method to come to a standard cost price. Yeah, probably you should, because otherwise you don't have normalized cost prices that you have in that area. And please be aware that a cost price is something completely different than a selling price. A selling price is a tariff, so you can play around with discounts or whatever you want. Think about the whole printer industry, where you buy very cheap every time you see a printer. You think, oh, this is a cheap one, but then whenever you have to buy a cartridge or a what is it with the laser printers that you have to put in, that's always going to be very expensive, and that's because they price a printer a little bit below the cost price, but the cartridge is going to be the one with the margin. So there's a lot of playing around with it. And then, of course, that's completely different with revenue again, because what happens in your invoice is yet another matter. To give you an example,
I always like the impression that like costing is a fact and pricing is a choice.
Very nicely put. Yeah, very nicely put. That is the difference between these two. And actually, in this case, you could either, you have these cost prices are a fact and these cost prices are normalized. So there's a little bit of choice in there as well. But very well put, Lim. And I'll give you an example. I have done a cost price analysis for about 800 elderly care providers in the Netherlands. And we had to come up with a standard cost price model. So a standard cost price model, but then for 800 care providers. So we had 800 times this left-hand side, which you had to normalize. So we had to really come up with stringent rules to say, okay, any like really specific one-off items like layoff of personnel is not going to be included. These things have to be included, other things not. So this is really like how the real world has to see with it, because every time you come with the data of a certain year or a certain month, depending on what your periodicity is of making a model. Where do like things financial and managerial accounting come together? I'm looking a little bit of time. I want to be aware of time as well, so I'm gonna skip this part a little bit. But this is the picture that I wanted to show. In general, you would say I have my costs probably be in my whole complete general ledger system, but I also have my volume somewhere in my sales or production system. So what I always say is somewhere at the resource level, you can actually like hit two of these elements, because if you would play around and say, okay, this is my actual cost for this given month. Let's say it's going to be May 2024, and I can see what kind of products I've produced or a service I delivered in 2024. And I can actually calculate based on my managerial costing standards, given the fact that I have so many products or services. I think that I should have done so many activities that would have taken up so many of my resources. And given the fact that I have a standard cost for my resources, that would be my cost level at these given volumes. But now I would actually confront them with my actuals and see that I have a difference between actuals and something that I would have calculated from a managerial perspective. What do you do with that? What do you do with those differences? What kind of conversations will you have, either within the finance department or with your operational or with your commercial department? Well, what we always advocate for, and that is going to be my last slide, and then Lim can take over and see an actual situation. What we always advocate for is have a good look between what you thought it was going to be budget-wise and what your actuals are, and have the right conversation. And I won't go like completely through, and I've already like simplified this version, but this is an example where we would have expected that we would make 81 products. We actually did 82, as you can see here. Well, given the fact that I did 82 instead of 81, I can see things like, okay, let's first look at my revenue side. I have an actual sales price of, what is it, $3 something below what I had budgeted. Given the fact that I've sold one more, well, I'm still having $863 in the plus here. So I'm losing a little bit on price, but given the fact that I have an extra volume, I am a little bit in the plus here. However, I also have this $3 that I lose. So this is my minus. So together, it's 600 in the plus that I have here. That's my revenue side. On my cost side, I have a volume difference because I had expected to only produce 81, but I have actually produced 82. So there's a little bit of extra cost here. And apparently I have some unknown difference as well. And our advocacy here is try to have these kind of like very detailed breakdowns of both volumes and price issues, efficiency issues, as well on the revenue side, sales price issues and revenue issues. But this is a very short overview how these two can actually meet each other. So they're not like enemies, which sometimes the people used to say, but they're actually friends. And with that, I'd like to get to Lim. Or maybe the last slide is where does it all sit? Of course, this is all in this profitability analytics where it hits both managerial costing and revenue management. We haven't talked too much about investment management. That's not for this topic. Lim, can you tell us a little bit about USPTO and how they use these kind of principles in that area?
Absolutely.
I'll do the slides for you.
All right, thank you very much. So USPTO, it stands for Patent and Trademark Office. So they're part of the Department of Commerce. They're an agency which grants patents. If you apply for a patent, they're the organization who actually do that here in the US. Same for trademarks. If you want to register a trademark, that's what they do. And they have a third part where they look at intellectual property and have some enforcement, some policy, the protections around that as well. So those are basically the three things they do. The patent and the trademark are the most important ones, obviously. But they are fee funded, which means that if you apply for a patent, you actually have to pay for that. So in the end, they want to be like budget neutral or zero budget. So they don't have to make a profit, but they do want to recover their costs. They want to do as much collections that they actually spend is. Where you come into the same managerial cost accounting question here. And if you look at some of the key data here on just to give you an idea about what are we talking about, there's 14,000 people work there. Which these are all publicly available data from their annual report. You also can see what we're talking about in terms of spend. They spend about 4.2 billion a year. You can also see their revenue, also 4.2 billion, but there is a small difference. They're expecting here in this 24 budget. It's relatively small compared to the total amount, obviously. But there can be a difference, obviously, between what you spend and what you collect in terms of revenue. In the private sector, that will be called the profit or loss. Here, they call it like a budget difference or something that needs, if it's a negative number, it needs to be funded. And that's why they have a so-called operating reserve. So 1 year it might be slightly over, the other year might be slightly less. So in the end, they want to make sure that, that's covered, that they don't run into issue at the end of the year that they don't have enough money to do their operation. And for 24, you can see the net appropriation. Appropriation is a formal term from how do they ask Congress for money? No, the net appropriation is actually zero. So they don't ask for any money. They expected 4.25 billion in revenue to be enough. They have a little bit, like, what is it? 3 million or something like that, that they, or 30. Anyhow, it's that many zeros at some point. It's 30, but that's 30. What they use to operate. Yeah, 30. That's what they use the operating reserve for. And part of that is actually because to come back to your regulation and law things, because for small businesses, they actually there's a new act, a new law where small business get a discount if they apply for a patent to stimulate innovation by small businesses. So they don't have to pay the full fee, but only they get a discount, which of course you can see then in their revenue that if they would do the same patents for non-discounted, their revenue would be a little bit higher. So that's why there's a small difference here. Also to give you a little bit of an idea of what we're talking about in terms of volumes. So approximately 600,000 patent applications is what they expect in 2024. About 300,000 will actually be issued. There's always, the lead time can differ. So if you look at it from 1 year perspective, some of those actually take longer than a year. And then you can see it's about 50% currently actually being issued as opposed to being applications. And then some of them actually appeal when they don't get their patent. There's a whole trial and appeal organization as well. That gives a little bit of an idea on the size of the operation, what we're looking at, and how they're funded, which is interesting because they have to actually set prices and then have to look at their cost, whether they actually stay within cost or whether they go over it and why that is, and look at the whole performance of that as well. So USPTO has a long history of doing this kind of cost modeling because they always were, or I don't know always, but they've been a fee-funded operation for a long time. So for about a decade, they used SAP, and since 2015, they've been using CostPerform. And strategy-wise, obviously that's important, and you want to make sure that your selling price is based upon your cost. I mean, you can imagine circumstances where that's not the case. Sometimes you want to set your price in order to gain market share, and then you might set your price below cost, and then it doesn't really matter what your actual costs are. But in this case, you want to be able to see that the collection per type of patent or trademark actually covers the cost of actually doing so. So they have a whole department within the agency. They call it activity-based information, ABI. That's what the department is called. I don't know the exact number of people there, but it's like 10, 15 people doing nothing but, well, they actually deliver information, but in its core is the cost model there. And they do it, like you said, they do it quarterly. For now, they might actually go to monthly at some point, but for now they do it quarterly, so they can measure the actual year-to-date analysis, see if they're still within cost, see where the potential issues are, so that they can actually act before. If you do it annually, then you might act a year after the fact. But now you make that period a lot shorter. So if something is running out of bounds, you can act a lot quicker. And the interesting piece about this organization is they actually have multiple models. So they have a model for each organizational unit. So you mentioned already TBM. So they have a CIO organization, and they have an IT model, actually based upon a TBM taxonomy. And they have a CFO model. They have a CAO, they call it, it's more like HR. So there's a couple of supporting models, and then there's a number of direct models. So the patent model is obviously a direct customer-facing model, if you will. The same with trademarks. Policy is kind of like a mixture. And those models are connected, physically, literally connected in the model, where output of one model is actually input of the next. So the CIO, the IT services are actually quantified and have a cost, and then they are allocated to the consumers of those services. So the CFO organization gets cost allocated from the CIO organization, but also the patent organizations and the trademark organization also gets IT cost allocated. The CFO cost gets IT cost allocated, and then the CFO also allocates its cost to the other organizations, the trademarks and the patents. And those models are literally in CostPerform dynamically linked, which means at some point you can actually, if something changes, you can actually see what it means for the IT organization. If something changes on the patent or the trademark side, or the other way around, obviously. And like I also mentioned, automation and repeatability is key, and that's what they've done here. The whole process is automated. I think the whole process to update the models is a couple of days. The majority of the time is then after that the actual analysis. Like, okay, are there any outliers? Do things make sense? And if you compare with previous periods, what kind of significant changes are there? So it's more about the analysis, and also the reporting back to the consumers of the information. So the actual the board, but also the direct, like the patent organization and trademark organization, provide them with the information of what does it look like.
And Lim, the
All right.
actual
Yeah.
actual running of the model doesn't take like that. That's neglectable, isn't it? Like the calculation.
Oh, the actual, yeah, exactly. When they start their update process till they're finished is like I said, a couple of days, and out of that, the actual running is minutes.
Yeah. Okay.
It's more getting the data in the right place. But even then, when you talk about a couple of days, maybe 2 or 3 days, that's relatively quick. And they only can do that because it's highly automated. Well, this looks familiar too. Every model basically has this kind of structure, whether it's the patent model or whether it's the CIO model. So they have either their actual line items or their budget line items, which are then grouped in, they call them resource centers. They're basically resources, which are then allocated to activities. And those can be supporting activities and primary activities, where the supporting activities are also allocated to the primary activities. And in the end, the primary activities make up the products and services of that organization. And you can have another layer below that, which is the actual customers. So sometimes that's internal. That's where the customers actually matter in this case. When you look at the patent and the trademark models, and the customers are the individual applicants, really. They haven't gone to that level yet. They look at the product and the fees and the breakdown of that, but not in individual customers just yet. Not sure that matters. You might be able to group them into, where do they come from? Yeah, this overview gives you, so in the end, customer facing at the bottom is the patents model and the trademarks model. And you can see, so it's a mixture of a waterfall approach and more reciprocal, where the CIO model is basically where it starts. So they don't get costs from other departments. They just distribute their costs or allocate their costs to all the other ones, basically. But there is some reciprocal allocations happening with the CFO and the CIO model as well, where they allocate costs to each other. But in the end, all the costs end up with the patent and the trademark model, where you can see, okay, where do the allocations come from, based on what. So for instance, certain systems being used by those organizational, by trademarks will end up as actual resources in their model, which will then be allocated to what are those systems for. And I think that's always what you're missing if you're looking at an IT organization in isolation. You see the systems and you see who uses it, but you don't see why they're using it and how they're using it, and what. And that's what you can actually see if you link it all up like this. So you can go a step further. But the fact that this is all in one model, I think, makes it very interesting. So you can see when you talk about causality, you can go all the way back and see how all things connect to each other. This is another overview from their annual report, where you can see, okay, what is that, just for some additional information, what does the patent process actually look like? So in stovepiped here, you can see it's pre-examining, examining, and post-examining. Pre-examining is when they get the application, they do all kinds of recording and screening, and before it goes into the actual examination process. And you can imagine if you apply for a patent, you need to have all kinds of subject matter expertise, right? Otherwise, how do you evaluate whether a patent makes actual sense and whether or not? So they have pretty high-paid people who are experts in their field, and that can be, in utilities or in chemical, or because most of those patents are rather technical. And they have to be examined. So that's what that whole examination process is for. And you see also that it's an iterative process, also with going back and forth with the actual applicant and with reviewing all that. And in the end, it either gets granted or not. And if it's not, then you have some additional activities you can do with appealing to that. And there's court and litigation with that as well. So those are the way it is defined within USPTO. But if you go to the next slide, we can see that those same activities. So this is a screenshot or 2 screenshots from their primary activities, and you can see the same processes. So you see on the left, you see all patent activities, and you see process 1 is the pre-examining, just as we saw, and then below that you can see it in the different main processes they have within the patent processes. And then you could even expand more, where you can see it by type, whether that's in utilities, or whether it's chemical, or whether it's telecom. So that's for pre-examining. For examining, on the right-hand side, you see basically the same thing, where you have, that's the main process is numbered in this case, which I kind of like, and then below process 2 examination, you see 201, 202, 203, all the way down, where they analyze those and examine and search for whether that's already done somewhere else. So also internationally, there's a lot of things they have to look for and have to see whether that has been done before.
And Lim, just for our information, do they write time on all these activities, or is it like
Yes.
a expert judgment on how many time they're spent? Is it based on standard, or is it standard and actuals actually?
Yeah, yeah. There's 2 things to that. They have. Can you go 2 slides further, and then we'll go back? I think 2 slides further, it gives you a little bit of idea on the Yeah, oh, no, one back. It was the next one. Sorry. No, sorry. Back. That's not back. Here you go. Here you go. Here you go. Here you see the resource centers, for instance, and what you see there is, they call them tech centers, where you see whether it's biotech, chemical, computers, and electronic commerce. So those are basically all the areas. So they have specific examiners for those specific areas. So obviously, people specialized in biotech will focus on applications for biotech and not for communications, right? And on top of that, they also actually write time. They have a time and attendance registration system, so they know exactly what kind of activity, how many hours were spent on that. So they can measure exactly the amount of dollars spent, well, time and therefore dollars spent on each of those activities. And each of those activities are actually allocated to the right, products and services, which you will see in the next slide. Yeah, so they have products and product fees, where you can, for instance, if you look at examining of utility patents, then they have fees for the different kind of things, the different kind of services they do, which you will be charged if you apply for a patent in that area. And they know exactly, how much time was spent on each of those in total. And therefore, there's a standardized fee for each of those services they provide. Which brings me to the next piece. I think if we go to the next slide. Yeah. So over the years, if you look at the descriptive continuum on the left-hand side, they've been maturing, all the way from the beginning, and I think they're about 6D is where they are right now, or where they were recently. But they have a good insight in, well, I think that's the next slide where I actually describe that. Yeah, 6D, where, they look very thoroughly at what is direct, what is indirect, and they know exactly how much they spend on what. But currently, they're actually in the process of going to a more predictive modeling as well. Since they already know how many hours did we spend on each activity, they actually know the amount of the activity as well. So they are very rich in the amount of the type of data they have. So it's relatively straightforward to then be able to calculate, what is the rate for how many hours did we spend on each of those activities on average. Because we know the amount of hours exactly, we know the volume of the activity also exactly. Those activities are already allocated to the product on a causal relation basis. But if you spend 10,000 hours on a certain activity, the activity took place 1,000 times, then on average it took 10 hours, right? And by knowing that, you can then use that information, especially if you have it, historically, so you can actually see if that 10 hours actually makes sense in the years or quarters before that as well. So you can do a good evaluation and get to an actual standard based on actuals. And take it out, you know, what you said, like if there is any incidentals in there or not. And then you can use that and see, okay, we expect more patents in that area or less in that area. We expect more trademarks in that area. What does that mean? So then you can calculate back. That means X amount of volume of those activities, which then consume Y amount of resource of the different tech centers, of the different, at least for the direct costs, whether those are systems, whether that's labor, whether that's contracts or contractors. And then, of course, you also have to look at, okay, what does it mean for the indirect ones? Do I treat those as fixed costs, or do I treat them as, or is there also some sort of relationship, causal relationship between the indirect costs as well? But that's the phase we're going into right now, and we'll focus on the direct cost first to see what that looks like and to see how we can do that. But you know, all the available data is there. So it's actually relatively exciting to see, you know, what we can do with that and how we can get to the next level in terms of maturity. And I think if you go back to the Gary Kokins's maturity model, yeah, I think what we get to is the resource consumption, accounting, and planning in 4P. Is the level of maturity we'll be able to get to relatively quickly. Yeah, you're on mute.
Yeah. And maybe to add on that, I was skipping a slide earlier on. Oh, I'm skipping a slide earlier on because of time. But here you see an example of where I have a back office
Right.
staff, and the back office staff does a lot of things. These are all the activities, but I see all of a sudden that I have a lot of hours
Right.
missing actually at my back office staff. So they're actually doing a lot of overwork to get things done. And this is like an example to deal around with capacity elements in CostPerform, where you can see those things. For me and Lim, this is a very logical picture. I totally understand. For you guys, it isn't. But just to show you that we've been, able to accommodate that maturity increase at all the clients as much as possible, and hopefully we can keep that up in the future as well.
Yeah, well, what's especially interesting with the USPTO model is if you go back to that model, how they are connected. Yeah, here. So if you change the volumes at the bottom at your patents model and your trademarks model, you obviously want to be able to see what does it mean for the resources within those models, like with the labor, but also what it means for your IT organization. How does it impact your CIO model if you do more or less of the different services? How does it impact that CIO organization or the CFO organization? But especially the CIO one, because you know nowadays, of course, a lot of the direct costs are actually IT costs with the different systems they use, and being able to see what that looks like, I think is very interesting. So you have.
So in a few years' time or in a few months' time, you will see not only an arrow pointing downwards, but also an arrow pointing upwards, Lim.
Oh yeah, absolutely. Because traditionally they've been looking backwards, but now you want to see it the other way around. So if you know the patents and the trademark folks actually demand certain services based upon their output and what it means from that organization. But traditionally those costs are considered, you know, I wouldn't say IT costs is overhead, but a lot of the indirect and overhead costs are in other models. But like this, you can actually create that causal relationship between models as well as within a model. So within a model, you also have what is direct and indirect, but you also have that between models here.
Yeah, and then without losing the fact that you would still have your financial accounting information of that specific in there. Yeah.
Absolutely.
Yeah. Okay, thank you very much, Tim. I just am a little bit wary of time. We only have 7 minutes left, and I want to keep some time of questions. I know with us that is usually a problem because all of a sudden time is gone. But I'd like to keep 7 minutes of time of questions. If anybody of you would like to raise a hand, Rafe, how can we best do that? I think people raising a hand and then we give them the floor.
Well, and there are a couple questions in the Q&A feature, so I'll
Oh,
ask those now. And sure, and if others want to ask questions, that would probably be the best place to
to
put
write
them.
them down. Yeah.
Yeah.
Go ahead,
So
ask.
welcome.
Be the asker here, Rafe. Yeah.
Absolutely. And sorry for muting you for a couple before. So, question: the time between items within an activity varies, perhaps substantially. For example, the simplicity of a patent application, uh, the time for a simple patent application versus a complicated one. Does the model weight the more complicated items more heavily, or use a probability distribution?
I think they're actually different activities. So they already made the distinction between the area it's in, and then within that, there's different activities which basically correspond with whether it's a simple or a more complicated applicant. So they won't get charged the same fee. It will depend. Obviously, if you apply for a patent, it can differ. But yeah, they're already grouped where you take that into account.
So most likely, Lim, underneath, like let's say processing incoming paper, there would be still different activities which would either be classified as being high, medium, low, or something, or there would be a situation where they say, okay, but we know that all the techie ones are high, so that's good enough for us.
Exactly. They're gonna be more time in that anyways, between if the biotech ones are more complicated than the communication ones. So that distinction is already explicitly in there. But even within one area, you can also have differences, obviously.
Okay.
And at some point, you don't want to treat every individual applicant, individually and have them individual. You don't want all 600,000 in there, so you do want to group them, obviously, but you do want to group them in a way that they're relatively cost homogeneous.
Okay, good. Thank you for that answer. And again, if others have questions, please put them in the Q&A feature. Another question is with regard to using the model for predictive modeling, and how are risks factored into this modeling since the future is uncertain?
What do you mean by risk?
Okay.
Is the first question I would.
Sure. Well, that's Parvati. You might want to mute yourself, and feel free to. In fact, I'll mute you right now, and please ask your question.
Yeah.
Or explain your question.
Hi. It was indeed a very good presentation. My question is that, am I audible?
Yes.
Yeah.
So my question is, since you said that model can be used for predictive modeling too, so that was your last slide. I just wanted to know, since the future is uncertain, when you are doing predictions, there are risks. So how do you factor risks in the cost modeling? That was my question. Am I clear?
Yeah.
Thank you.
Well, it's estimates of what you think the future will bring, and you can have multiple versions of that, like a worst case, best case, or a more realistic scenario somewhere in between. And you can, and in terms of what do we expect we're gonna deliver, what gonna sell sounds funny in the government space, but how many of our products and services in a different area do we expect we will sell? And that could be a low number, medium number, and high number, and see what that means in terms of activities and resource consumption.
Yeah,
maybe to that.
Yeah, most of our clients use like 3 to 5 scenarios that they would calculate through, and then have a look at it. Okay, what would be the impact? So sometimes they think, okay, this kind of risk is very important for us, but then when they really calculate 3 different scenarios, they see that the cost impact is not as big. Then all of a sudden, it differs. But it's just scenario modeling. It's not that the model itself provides the risk. It's of course it's of course the inputs that determine the outputs as well. So that's I hope that answers the question.
Yeah.
Rafe,
So
any more questions?
So you're saying that the model can give you simulations, right?
Yeah, exactly.
Sure.
Yeah.
Sure. Thank you. Thank you. That clears my question. Yeah.
So there are no more questions,
Okay.
Oh,
which I
Great
think
timing.
speaks to the clarity of your presentation. It's looks like an incredibly useful tool for organizations to better understand and control their costs. I think it's great that it incorporates a lot of the concepts in the profit analytics framework. Well, I think we're out of time anyway, so thank you, Lim. Thank you, Sander. That was a
thank you, F.
really interesting case study, and it's not every day we get to see a real life case study. So it's really really appreciate your taking the time to present today and learn more about your software. It seems very powerful, and uh, hopefully more people are aware of it and will look at it and evaluate it.
Perfect. Thanks a lot.
Thanks
Thank you.
thanks everybody for joining us today, and have a great rest of your day.